We've heard a lot about inflation recently. Inflation remains stubborn, according to the Fed's preferred inflation gauge, the core personal consumption expenditures, known in your hood as PCE, core PCE, coming in at 2.8% in March on an annual basis versus the 2.7% that was expected. This is just the newest data point in a line of reports that have investors rethinking the timing of rate cuts. Only 30% of traders are pricing in that first rate cut in July, according to the CME FedWatch tool. You're seeing that data there and the probability. And stocks regaining some ground today after losses Thursday around a soft GDP reading. The S&P 500 and NASDAQ getting a big boost from tech earnings as well in the aftermarket trading activity and going into the pre-market and now extended into today's activity. So for more on this, and all of it, we turn to Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. Great to have you here with us. Okay, so, it's been a whirlwind of a week with economic data, with data coming from companies reporting earnings, some of the Mag 7 companies in representation there. Where is the clear prioritization that this market is giving this trove of information that's coming out at a fire hose type of speed?
Yeah, it's kind of interesting. We're having a bit of a repricing event that's happening in the market right now, and that is around higher for longer interest rates. As you just showed, the likelihood of rate cuts soon is declining, and that's because prices are staying very sticky. The other measure of inflation would be the core CPI, and what we're seeing lined up with that PCE number we got today is a month-over-month trend of just very sticky core prices, around 0.4 and 0.3% all year long, and that just simply means that prices aren't going down. The Fed has told us their target is 2% inflation, and they don't really have enough information or data to truly decline what would be interest rates today. So the market has to reprice that. Think of it this way. At the beginning of the year, they were depending on 4 or 5 rate cuts, which means the year-end interest rate would be 4% or slightly less. Now they have to reprice future earnings against a 5% year-end interest rate, reflecting really only 1 or 2 rate cuts possible. And that's shifting the dynamic of how future earnings are going to be valued. It has twisted things this week to the point where when we saw Tesla actually come out with a miss on top line and bottom line earnings expectations, but the stock went up because they actually are showing better future growth over the next few quarters than what the market is offering right now. We can compare that to the S&P 500, where we started the year at about 11 or 12% earnings growth expected. That would be from $225 per share up to around $250. Now that's being dialed back under the weight of higher interest rates to only around $242 per share. So only a 7 or 8% earnings growth. So if Tesla is moving up earnings by 14 to 18%, which is what they expect, now you're getting double the growth in that stock than what you're getting from the overall market. And that's why the stock price went up. And so that's really just the dynamic that we're seeing, is that in this moment, the earnings in the current quarter aren't as important as the guidance over the next couple of quarters for investors right now.
It's interesting. You mentioned Tesla. Tesla had once been firmly within the Magnificent Seven lexicon, and now, over the course of 2024, we've seen that Magnificent Seven conversation even shift into one of the Big Three or the Fantastic Four. We've heard a few different numbers tossed around, but ultimately here, it still does come back to a few things in the kind of intersection of roads here with the Fed's pathway and the policy there, as well as what the actual thematic play of generative AI looks like, and the investing and the amount that these companies are willing to invest, that's part of that intersection. So how does a shift in timing of rate cuts shift the portfolio strategies for those who have been over-indexed on the Mag 7 trade?
Well, the simple matter is higher interest rates make the value of future earnings go down. And so really it becomes a question of, are you properly managing costs and a higher interest rate environment at the same time? And we're seeing from these Magnificent Seven stocks a little bit different answer to those questions. To your point, at the intersection, what we're finding from Microsoft in particular is the cloud growth is up 23% in terms of revenue. Again, that's 3 times what you're getting from the market. And it also happens to be the most profitable business segment that Microsoft runs. So that leads to a better expectation of earnings growth on a net basis going forward. So again, the market is liking that. Google also a strong commitment now to shareholder value. 2 years in a row, $70 billion in share buybacks. Reducing the amount of shares traded increases the price, and now they're sharing a dividend as well. So they're looking at it in a couple of different ways, where these companies that are in a very strong cash flow position are saying, we're going to dominate this, whether interest rates are higher or not. And we're starting to see some of the other businesses have to struggle in order to control costs and a higher cost of capital at the same time. And that's really going to be the dividing line for investors going forward. Know what you own, know why you own it, and really pay attention to those high quality stocks that have low levels of debt, good free cash flow metrics, and generally speaking, you might want to look for companies that have low short interest as well.
There are some folks that may be watching and saying, hey, how do I, looking at what I'm invested in and knowing why I own it, how do I kind of remove emotion from a year where we've got, of course, elections that could impact the markets. We've got exogenous threats where we don't even know where that might come from, but that have a perhaps broader or pronounced near-term impact too. I mean, that impacts the strategy for a lot of portfolios that may be looking to retire soon. And so how do you kind of remove that fear, that emotion where you need to be strategic?
It's a great question, Brad. Thank you. And that's really those quality factors that I just described. Those companies that have low debt exposure and good free cash flow metrics means they're able to pivot their business if they need to. If one of those exogenous events were to happen, they are actually in a better position to be able to shift their business if they needed to, and they have low levels of stress. So standard deviation would be a measure of that, meaning that if the market is moving in a particular way, typically to the downside, these types of companies have less downdraft in those moments of time, because this is where shareholders are going to go when they're looking for a safe haven. These higher quality companies, better profit structures, low levels of debt means they're less influenced by negative events that happen in the marketplace. So as a person that wants to make sure that they're protecting more of their assets to the downside rather than being concerned about double-digit growth, this is definitely where you'd want to go. And also the conversation earlier about dividends, remember that dividends over a long period of time have contributed as much as 40 to 60% of the total return in something like the S&P 500. So having a strong, stable base of high income paying stocks is also a great way to defend your portfolio against downside volatility.